This goes with what we were kind of just talking about, is that you can flip-flop in 2 weeks. You can't have an investing strategy long-term with that.
No, although I suppose what we've been selling this rally all year because we didn't understand why it rallied. And as I'm here in New York, I find it interesting that the S&P's up nearly 16%. Earnings are now going to be down for the year. So we're talking about re-rating, which is entirely all about the Fed cutting rates. And I would still argue that the Fed cutting rates tells you that the next thing that happens is you get serious cuts to corporate earnings, potentially rising defaults in the banking sector. I don't see this as a risk-on moment, but clearly the sentiment in the markets is they're baying for these rate cuts to have the equity market go higher, whilst the bond markets with the 10-year now heading towards 2% is telling you the world looks pretty dark out there.
We tend to blame it all on trade and the uncertainty surrounding trade,
yes,
particularly U.S.-China, but not exclusively. Is that really the whole story, or are there other phenomena? Even if we didn't have the trade problem, would there be other issues out there that investors would be concerned about?
Well, I still think the story that happened when I was here in New York in November, the tech story, I think is still undermining, I think, a large part of investor sentiment. The Broadcom warning last week, I think, is symptomatic that there's going to be no second half uptick in much of the tech sector. There's no Apple product, there's no Huawei product now coming in the first half of next year. So I think that disruption will slowly flow through those important parts of the sector. And your retail sales numbers sort of bumping along, but it's the only good bit of the US economy. There's very little investment, very little housing, even with the lower rates. So I think we're quite, on thin ice, and our theme is the hunt for income. So we would look at Asian debt, some emerging markets, and US short duration and US high yield. We don't see the recession just yet.
Well, selling equities, though, seems to be a popular trade. In the latest fund manager survey of Bank of America, when I mentioned that U.S. Treasuries are the most overcrowded, it's because you're selling. If you look at overweight equities versus overweight bonds, you see how that's really reversed just in the last few weeks, and it's all about selling equities and buying bonds. So are you getting caught up in sort of the momentum of the selling? Like, do you need to rethink that part of the strategy now, too, go against the grain?
No, well, I think, to be honest, I was wrong last year in wanting to take risk outside the U.S. equity market, which, of course, cracked down to everybody in Q4. So because our view of 2019 had been a slowing, fragmenting economy, we still see, I was in Beijing 3 weeks ago, we still don't see the Chinese economy picking the rest of the world's economy up. And if you think about making America great again, what I call keeping China great again, both the two largest economies in the world are now trying to internalize their sources of growth. So it means that Germany and Italy, Japan, South Korea, they've got to find their own sources of growth. And to your point, they're not restructuring to create it. So I think that there's still problems of pretty dull outlooks into the second half of the year.